this is Alan Molina, President of Servus Capital Management and your financial advisor. I wanted to do a first quarter update, review a little bit of 2022, but also really talk about 2023. I'm going to try to make it brief and go through the high points in order to get really to the portfolios. So today what we're going to do is we're going to review 2022, go over the 2023 economy, and how do we deal with that going forward. Well, first of all, in the portfolios, I have two of them, dynamic asset allocation and the QPM 1X and 2X. The dynamic asset allocation is about 12 to 15 portfolios. It really depends on what the client wants and the asset allocation that they prefer. You know, what I mean by that is how much risk they want to take. And I have about 12 portfolios. Some beat the index, some didn't beat the index, and we'll get into why. The QPM 1X and 2X, both of them beat the index. That's not really much of a solace. They were both still negative. And my previous videos and the emails to you clients, you know why that is. It's the biggest reason is the decision in December. But the individual portfolios may differ a little bit depending on when the flows came into the account or out of the account. So, but that's a general overview. My suggestion is you, my client, let's do a review, let's talk about it, and we'll get more into why later. Now here is the reason why the dynamic asset allocation portfolios did so poorly. You see this red bar? That is the returns of the 10-year government bond. This was put out by Bank of America. It's all the way back. It had the worst year since 1788. And realistically, bonds did poorly and stocks did poorly. And the reason being it was an inflationary recession or inflationary down market. And it just, normally in a recession, the long-term bond does well, 10-year plus in duration, but it got hammered. So where does that leave us? Well, in 2023, I'm looking at the liquidity of what's going on. We're reviewing 2020, not reviewing, but looking at 2023 now. The pink line is the Fed liquidity. It jumped up, the market ran up, but if you look at it, it basically follows each other. As Fed liquidity goes down, the market tumbles. Well, there's a big divergence between the stock market and the Fed liquidity. So I expect that to fix itself. And this is another example of Fed liquidity. In this green dot, you can see where Yellen in the federal government, because of the debt ceiling possible crisis, she took cash out in order to have cash on hand in order to meet the needs of possible issues with the debt ceiling. And as that happened, liquidity went up, but now it's reversing. So that's not a good thing. And this is a chart. I'm not going to go, aren't you glad I'm not going to go over every jot and tittle? But this is put out by Hedge Eye, and one of the folks I use, like, you know, Bank of America, things like that. But the first line is the USA. The liquidity is down for 2022. What's interesting is China, of all of these, is the one that's most pumping liquidity into the market. Yes, we have maybe a little bit of Indonesia, but that's kind of hard to invest in. It's so small. But so what we're doing right now is, if the government is pumping money into the economy, you invest there. So we're investing in China and have a negative outlook on the United States. Okay, now look at unemployment. You've heard of unemployment, that it's at 3.4%. And you've heard that unemployment cannot be at this level and go into a recession. But look at this, 1948, 3.4. June 1953, 2.5. May 69, 3.4. April 2000, 3.8. January 2000, 3.5. So we can go into a recession from this level. But at this level, we won't have a recession until unemployment moves up, generally a 0.5 percentage point. So if it goes from 3.4 to 3.9, generally we have a recession. Now this is this is looking at from another firm. They put out this research. This is the recessions back to 1953. And this is before a recession occurred. This is actually the first month of the recession. And as you can tell, the unemployment was pretty flat. It moved around a little bit, but it was pretty flat. But once the recession started, unemployment took off. So that is what we're looking at. And yes, you can have a recession from these levels. Okay. Now this is, I took a snapshot of today. What is today? Today, I believe, is February 24th, 2023. And this is a snapshot of this morning. And sometimes in your portfolio, nothing works. And that's one of the most frustrating things. Because I remember back in 2007, 8, and 9, when I was helping clients in managing their assets, sometimes nothing worked. And it's highly frustrating. You say, explain this. This is the 7 to 10 year Treasury bond. It's down. This is the 20-year Treasury bond. It's down. This is gold. It's down. Silver. It's down. The S&P 500. It's down. The NASDAQ. It's down. The dollar is up 0.18%. And this is Hong Kong. And it's down. So we could probably find some others that were positive today, but they are few and far between. And so just preparing for 2023, sometimes things just don't even work. And it's very, very frustrating for you, but it's also very frustrating for me. Now, this is another chart, aren't you glad we're not going to look at in depth. The reason I wanted to show you this is from February 15th, 2023, and it's the zero dated options. I've included, I think, 2 or 3 links in the email that I've sent you. If you want to look at them in detail, go right ahead. And it explains them and the concerns that I have, but also many market participants. And this is just showing you, if you can zoom in, this right here shows you the volume of the options on February 15th. Not only in calls for the market to go up, but puts to the market to go down. It opened up at this day at 411. Okay, that's good because the previous close was 412. You know, and I'm rounding. What ended up happening was it went to 412, it went to 408, and then it closed around 413. 412.64. But what ended up happening is it hit all of those options. And so this has been going on since November of 2022, these daily options. It's not something that has been around for many, many years, but it affects all portfolios. Because Apple had the worst numbers, earnings in 6 years, and yet I believe that day they were barely negative, and the next day they were positive. And all has to do with zero dated options. And they bully the tape or the market up and down. And so this is affecting not only QPM, but it's also affecting all the other dynamic asset allocations. So what about 2023? 2022 was an inflationary recession. You know about it just as well as I do. Tremendous amount of inflation. It hurt a lot. 2023 is an economic and earnings recession. It's going to be a time to where corporate earnings go significantly negative. It's going to be a credit event, bankruptcies, homes being foreclosed, cars being repossessed. It's not a pleasant time, and it saddens me. That being said, what can we expect? Number one, there's going to be greater volatility, not only up and down in the stock market, but also much more larger gaps. Like today, Friday, yesterday, the market closed up a little bit, but then it gapped down today, all because of inflation data. It's going to be much more dramatic over the next 6 months. And a lot of times we cannot prepare for that. Number two is I suggest you and I meet to discuss your risk tolerance because some people have said, you know what, I can handle a 20% downturn, 25% downturn in my portfolio, when in reality they can't. And I'm not saying that's what I'm forecasting. I never forecasted it. I don't want it, but sometimes life happens and you have to take in those accounts. And what I've tried to do is reduce the risk in portfolios, but life could happen. And let's discuss risk tolerance and time horizons. Number three is I hope these two things never happen, but I look for the Ukraine war to expand. I hope Russia does not use tactical nukes, nuclear warheads in Ukraine, but it just concerns me. It just concerns me because Putin is looking at this as almost a religious war now. Not only I want my homeland back, but also a religious war. He thinks himself as a strong Christian. So it concerns me. Then Taiwan to have greater risk from China. There's a lot going on in China. I'm not in China, but in Taiwan. People are moving out. And so my suggestion is just be wary, and as I am, and we don't know what's going to happen. And then fourth, areas of risk we don't know about. It was interesting, in 2005 I attended a symposium, the Nikubo, it's a university endowments in New York. In 2005 I was at Bear Stearns, I think it was 2005, 2006, and Bear Stearns said we are the greatest at risk management on Wall Street. And they gave us these pamphlets about collateralized debt obligations. And if you watch the movie The Big Short, they go into great detail about it. But people didn't know the risk of those, and they didn't expect that. Here, there's areas of risk that are going to occur in the next 6 months, a year, that we just don't know about. And the goal is to protect the portfolios or diversify or try to respond quickly, but sometimes that just doesn't work. And we just have to be very proactive. And finally, this too shall pass. We're going through a storm. Buckle up, and it will pass. Okay, what does that mean for the portfolios? The dynamic asset allocation is, first of all, last year, 2022, I was probably rebalancing portfolios about once a month. Towards the end of 2022, I realized that, I remembered back to 2007, 8, and 9 and how active I was in portfolios. That how often I would meet with clients, but also sometimes we would make multiple changes during the week. And so that's what I'm going to be doing. Trying to keep up with the economic data, market sentiment, things such as that. Because the goal was A, to grow the portfolio, but also to try to protect the portfolio. And we never can grow the money if we take no market risk. And so we just have to be prepared in order to make quick changes. Because what happens if earnings and the GDP start falling, which I expect, earnings quarter over quarter and GDP quarter over quarter, and then the Federal Reserve comes out and says, hey, we are going to loosen monetary policy, we're going to lower interest rates. The market's going to take off and run. If we aren't prepared to take that risk, then what ends up happening is we miss out on recouping losses, but also encountering gains. Third is I'll use gold a lot. Normally I don't use gold except for in these down times. We use T-bills, very short dated treasuries, but also ETFs that invest heavily in T-bills, market neutral portfolios. What I mean by that is, and sometimes we will have a small short through an ETF, not actually shorting the market through borrowing shares and selling, but just use an inverse ETF, like to short retail stocks or technology, but going long China and things such as that. Not significantly, but basically a market neutral portfolio. And then we're going to use a lot more cash. Even in QPM today, we have I think 35-40% cash. I think that's the number. I'm trying to go back in memory, but trying to use a lot more cash. Then, what does it mean for the QPM 1X and 2X? Well, one, because of the zero dated options, and like I've said, we've covered them a little bit here, but I also have some links in the email. I have decided to expand the QPM to multiple asset classes. And how I'm doing that is I'm using asset classes that are either correlated or not correlated to the S&P 500. And in doing that, what ends up happening is it's not bullied as much as the S&P 500 is, simply because of the zero dated options. And so my expectation is to have a wider array of investments in the QPM. Like today, we're invested in areas such as the NASDAQ. We have a little bit of S&P 500. We have some gold. We have a little bit of China. And the reason being is we're trying to cover multiple asset classes as we follow the trends of the S&P 500. Then I'm going to use a higher percentage. Oh, I jumped one. Sorry about that. I'm going to use a smaller percent positions in the portfolio. What I mean by that is, instead of using 90% of the S&P 500, which that's what it's been back tested to, I'm going to use those asset classes that correlate to the S&P 500. And then what we will do is we'll spread those out. Number 4 is using a higher percentage of cash, especially when the 3 time frames are not in agreement. Remember, there's the trend trade signal. Today we got yesterday it was long trend, long trade, long signal. Today we got a signal that said the trend is now short. And the trend popped up. And so what we're going to do is we keep a larger portion of cash when we're going in these zones where we don't really know what's going on. And so it's my expectation that we'll go short and ride the longer term trend of the S&P 500. And then the goal is much more active at harvesting gains and cutting losses. What I mean by that is, if we have in the QPM, let's say we have S&P 500, NASDAQ, semiconductors, gold, some US dollars, and some bonds. And it's because as interest rates move dramatically, we can take advantage of that. And so what ends up happening is, as that occurs, you sell a couple of the winners, and if there's losers, you just let them go. Sometimes you just reduce the entire portfolio and wait for a better opportunity. So that's really an overview of the 1X and 2X. It's a very, very tough time in the stock market, in the economic environment. It reminds me of 2008, when I would get up at 3 and 4 o'clock in the morning just to watch the bond auctions in Portugal, Ireland, Italy, Greece, and Spain. They called it the pigs, P-I-I-G-S. And because how the auctions went determined how the stock market went. And so trying to take it a very nimble approach, it's going to be much more volatile. That being said, I'm trying to reduce exposure, trying to reduce risk. And remember, nothing is guaranteed. And if you're concerned, if you're worried, if you want to meet, I'm here. But I'm trying my best and doing a tremendous amount of research. I won't be meeting very many prospective clients unless they're here, simply because this time and age, what ends up happening is there's a lot of unknown, because no economic downturn is the same. And what may happen is, I'm expecting probably May, June, July, somewhere there's going to be a big start of a big rally up. Maybe August, somewhere. I'm not really sure, but the third quarter GDP should be a nice bump up, but that's a long way away. So if you have any questions, give me a call, 434-316-0246. And this is just disclosures, where to get my ADV, things such as that. You're a blessing to me, and I thank you for allowing me to serve you. And this too shall pass. And give me a call.